their real average hourly earnings are still very much on, so they're still earning more. As long as Americans are earning more money, more than inflation, they will spend and the economy will grow. Okay? Numbers don't lie. How about their net worth? You can see in terms of US households, their net worth, overall net worth, this is in the share market, this one green stock market, owner's equity in household real estate in red, pension fund in dotted, equity in non-corporate businesses, they're all near record highs. Americans are rich, if you look at the numbers, right? Not all, but most of them are. And just in, okay, American households have 18 trillion in cash, above pre-COVID level of 13 trillion. Who says Americans have no cash? They've got 18 trillion in cash in total, more than 13 trillion. Number 7 reason to be bullish, and this to me is the most important reason. Again, generative AI, artificial intelligence, and automation to increase productivity and drive earnings growth. I've talked a lot about this already in my 6-wave event last year, so I won't, talk too much again. But generally, remember this. We are now in the beginning of the 6th wave of innovation, which is the AI revolution, which to me will have the greatest impact on economic growth, corporate earnings, and stock market returns. What was the last wave? The last wave was a 30-year innovation cycle from 1990 to 2020. During this 5th wave, you went over 30 years. That's a 10% annual return. Okay? In my opinion, this 6th wave that we just entered will be much bigger than this wave. It'll be much bigger than this wave. And that's why, although Microsoft, Amazon, Meta, Google have already gone up a few 100%, if you ask me, it's just the beginning. It is just the beginning. Alright? Yes, it may drop in the short term because after a wave up, you get a pullback. It may drop in the short term, which I'm hoping you drop so I can buy more. But if you look out 3, 5, 10 years, can these companies still double and triple and quadruple? I think they can. Again, I could be wrong, but I'm putting my money where my mouth is. I'm continuing to have millions in the market, and I'll continue to put even more into these AI. Right? Finally, now here's the interesting thing. Last year, the US market went up over 20%, right? But do you think that most retail investors and most institutional investors were in the stock market? No. Most of them got out of the stock market. So last year was very, very rare. Because usually when the stock market goes up, people are putting money in, right? But last year, as the stock market was going up, people were pulling money out. It's a very strange phenomenon, okay? So from this chart, you can see that last year, as the market went up 20%, there was a 240 billion outflow. People pulling money out of equity mutual funds and ETFs. And where did they put this money? They took the money out of the stock market, and where did they put the money? They put it into money market funds. What are money market funds? Money market funds are fixed deposits, time deposits, short-term treasury bills. So there was a 1 trillion inflow into money market funds last year because interest rates went up and it looked very attractive. So people rather get some bonds than putting into the stock market, which they thought was risky. Okay? So right now, we have 6 trillion of cash on the sidelines parked in money market funds. Now, when the Federal Reserve starts to cut interest rates this year and next year, what's going to happen? As they cut interest rates, suddenly these money market funds will be less attractive. And people will get frustrated, like, I'm getting less interest now while the market's going up, right? And they will start to pull their money out of the money market funds and put it back into the stock market.